Broker has a pitch. Now you get a CPA. A buyer found a business they wanted. The broker told them they'd qualify easily for an SBA loan. They had a good credit score, 10% down, straightforward process. You know what? They made an offer. The seller accepted. They went under contract. 60 days later, their SBA loan application was denied. The business didn't generate enough cash flow to service the loan at the price they'd agreed to pay. The debt service coverage ratio, a number the buyer had never heard of, came back below the lender's minimum. And you know what? The deal was dead. They lost their attorney's fees. Their earnest money was at risk. And they're starting the entire search over now with knowledge they should have had before they ever made the offer. SBA loans are one of the most powerful financing tools available to business buyers who are buying a business for under $500,000. They're one of the most misunderstood. That misunderstanding almost always comes from taking the broker's simplification as the full picture, and it isn't. But today, I'm going to give you the full picture. Every requirement, every common denial, and exactly what you need to know before you make an offer if you're planning to use SBA financing. Listen to me. We're going to get into the weeds and we're going to get down to brass tacks in this one. Hi, I'm Jason Schmidt. I'm a CPA, and this is video 2 of the Money Math series, the financial framework that protects buyers under $500,000 once they find a deal worth pursuing. Last video, we covered the true all-in cost of buying a business. This video covers how to actually finance it through specifically the SBA program, which is the most common financing vehicle for acquisitions in the range we're talking about. Now let's start with the basics because there's consistent confusion about what an SBA loan actually is. The SBA, or the Small Business Administration, does not lend you the money directly. They guarantee a portion of the loan made by an approved lender like a bank or a credit union. The guarantee reduces the lender's risk, which allows them to offer loans with a lower down payment, longer repayment terms than a conventional business loan. For business acquisitions, the most common program is the SBA 7A loan. This is the general purpose SBA loan, and it can be used to buy an existing business, its real estate, its equipment, and its working capital needs, and it's all in one loan structure. All right, now let's talk about the key terms of a typical SBA 7A business acquisition loan, right? The loan amount can be up to $5 million, well above what we're talking about in the $500,000 need. The repayment terms can be up to 10 years for a business acquisition without real estate and up to 25 if you have real estate included. Interest rates are variable. Currently, the range is prime plus 2.25% to 2.75%, and they adjust with the market. All right, the down payment. The SBA requires a 10% down payment from the buyer. A $300,000 acquisition, that's a minimum of $30,000. In practice, many lenders require 15 to 20% depending on the deal's risk profile and the buyer's financial strength. Okay, that's basic structure. Now let's talk about what actually determines whether you qualify, because the down payment and credit score are just 2 of the 5 things the lender will be evaluating. When the lender evaluates your SBA loan application, it looks for 5 things. Most buyers only know about 1 or 2, but today we're going to cover all 5. We're going to get into it. Factor 1 is the credit score. The SBA doesn't really publish a universal minimum credit score, but most approved lenders want to see a credit score of 680 or above. Some will work with 650 if everything else is looking strong. Below 650, and you're looking either at a denial or terms that make the loan really unworkable. More importantly, it's not just the number. Lenders are going to look at what's behind that number. A recent bankruptcy, tax lien, a pattern of late payments. These also can result in a denial, even if the score is above 680. Pull your credit report before you do anything else. Know exactly what the lender is going to see before they see it. Factor 2, the debt service coverage ratio. This is the factor that denies most applications and the one almost nobody knows about going in. I'm going to give you the, I'm going to get into this in its own special section later in this video because it deserves it. Factor 3 is collateral. SBA loans require the lender to take all available collateral to secure the loan. That means the business assets, the equipment, the inventory are all pledged. If these don't fully secure the loan, the lender will typically require a lien on personal real estate. So if you own a home with equity, that equity may be required as collateral. This surprised buyers who assume the business itself will just fully secure the loan, and it doesn't. On a $300,000 business acquisition, the tangible assets may be worth only 80 to 120 grand. The lender needs the rest secured somewhere, and your home equity, yeah, that's pretty much the most common answer. Factor 4, post-closing liquidity. After you close the deal, you pay your down payment and your closing costs. Lenders want to see you still have some reserves. Most lenders want to see that you have at least 10% of the loan amount remaining liquid after the closing. On a $270,000 SBA loan, that's $27 you need to have left over not used in the deal. This is why the working capital conversation from the last video matters so much. If you haven't seen it, you need to go back and see it. Buyers who use every dollar of savings for the down payment and closing costs will fail this test. You need to have money left after you close, or the lender will not approve the loan. Factor 5, industry experience and management capacity. This varies by lender, and it's not a hard SBA rule. But many lenders weigh whether you have the relevant experience to successfully operate the type of business buying. A buyer with a management background buying a laundromat is a different risk profile than a buyer with no business experience buying a full-service restaurant. Now, this doesn't mean you have to have owned that exact type of business before, but having a clear, credible plan for how you'll manage operations and ideally some relevant background will strengthen your application. Debt service coverage ratio. This is the one we talked about earlier. And this is the number that controls how much you can actually borrow. And it's the number that kills more SBA applications than any other single factor. All right, here's the formula. The debt service coverage ratio is equal to the net operating income divided by total annual debt service. Net operating income is the business earnings after operating expenses, but before debt payments. For a business acquisition, this is essentially your verified SDE, the number we built in video number 2. The annual debt service is the annual payment on the SBA loan, that is interest plus principal. The SBA standard minimum of DSCR is 1.25. What that means is that for every dollar of annual loan payment, the business must generate at least $1.25 in net operating income. The lender needs to see that cushion. Can the business service the debt and still have 25 cents of every dollar left over? I want to show you how this looks on a real deal. The business SDE is $90,000. The SBA loan is $270,000, which is our $300 acquisition price, less the 10% down. Annual loan payment at the current rates over 10 years, approximately $32,000. Now, the DSCR is $90,000 divided by $32,000, which equals 2.81. That DSCR of 2.81 is strong. The loan likely gets approved on cash flow. Now, watch what happens when the purchase price is higher or the SDE is lower. Ready? The business SDE now is $60,000. SBA loan amount, the same, $270,000. The annual loan payment, approximately $32,000. So the DSCR is $60,000 divided by $32,000, which equals 1.875. Still above the 1.25, still likely to be approved, but the lender is definitely looking much harder at everything else. Now the third scenario. The business SDE is now $45,000, loan amount the same at $270,000, the annual loan payment same, $32,000. The DSCR, $45,000 divided by 32 is equal to 1.41. Now this is barely above the 1.25. This application is going to face serious scrutiny. One weak element somewhere else, this application is denied. The fourth scenario, business SDE is now $35,000. The SBA loan is $270,000, which was the same. The estimated loan is $32,000. So now you take that DSCR of $35,000 divided by $32,000, which equals a 1.09. That is below the 1.25. That is denied. And this right here is exactly why SDE manipulation from sellers is not just an academic problem. When sellers inflate their SDE by 30 grand through questionable add backs, they inflate their asking price. You borrow more. And the real SDE can't support the debt service. And guess what? You discover this at the loan application stage. You're already under contract. You've already paid attorney's fees. And you've already gotten emotionally invested in the deal. Calculate the DSCR yourself before you make any offer using SBA financing. Use only the SDE you can verify from tax returns. Okay, here's something that destroys deals completely and unnecessarily, and that is the SBA loan timeline. The SBA acquisition loans take 60 to 90 days minimum from application to funding. Sometimes it takes longer. In a deal where the seller has other interested buyers or the broker is really pushing urgency, 60 to 90 days creates serious pressure. Here's what this means practically. First, get pre-qualified before you make an offer. Most SBA lenders will do a preliminary review of your financials and give you a conditional pre-qualification letter. This tells you roughly how much you can really borrow, and it confirms you're basically eligible before you go under contract. Doing this first means you know your real budget before you start looking at deals and not afterwards. Second, when you make an offer, make it contingent on SBA financing. Build in a realistic due diligence and financing contingency period. 60 days is the bare minimum. Let me tell you, if a broker is pressuring you to close in 30 days on an SBA deal, they either, one, don't understand SBA or they don't care about your interest. Third, during those 60 to 90 days, you will need to provide extensive documentation, okay? 3 years of personal tax return, your personal financial statement, business tax returns for the acquisition target, a purchase agreement, lease documents, a business plan, your personal resume. This list is substantial. Have it organized and ready before you apply. Buyers who aren't prepared for this document requirement cause their own delays, and delays in SBA deals sometimes can cause the seller to walk. All right, let me give you the 5 most common reasons SBA applications get denied on business acquisitions so you can see them coming before they actually happen, okay? Denial reason number 1 is credit issues the buyers don't know about, such as, we talked about this earlier, tax liens, collection account, recent late payments. These appear on your credit report and they matter. Pull your credit report before anything else. Fix what you can fix and know what you can't before the lender sees it. Denial reason number 2 is, of course, the DSCR. The debt service coverage ratio is below the minimum the lender requires. The purchase price is too high relative to the verified SDE. The most common solution is either renegotiate the price down or use seller financing to cover part of the purchase price so that the SBA loan amount is smaller, or you may have to find a different deal altogether. Denial reason number 3, insufficient collateral. The business assets plus any real estate equity don't adequately secure the loan. Sometimes it's solvable with just additional collateral. Sometimes the deal has to be completely restructured. Denial reason number 4, the business has a record that concerns the lender. Outstanding tax issues, negative cash flow years in the tax returns, business in certain industries that SBA restricts. Do not assume any business qualifies for an SBA financing. Some don't. Check the SBA's list of ineligible business types before you get into a deal. Denial reason number 5, buyer does not meet the lender's overlay requirements. Okay, the SBA sets the floor, but the individual lenders, they add their own requirements on top, and we call these overlays. Okay, one bank may want a 700 credit score when the SBA allows it to be 650. Another may require relevant industry experience. Shopping multiple SBA lenders, not just one, is how you find the lender whose requirements align with your profile. Okay, here's your action sequence if you're planning to use SBA financing. Number one, pull your credit report today. I cannot stress that enough. Know your score and know what's on it. Annualcreditreport.com is the official source and it's free. Step 2 is calculate your liquid assets after the transaction. Down payment plus closing costs plus working capital reserve. Subtract all that from your total liquid savings. What's left needs to be at least 10% of the loan amount. If it's not, you have a liquidity problem and you need to solve it before you apply. Step 3, get pre-qualified with at least 2 SBA lenders before you make an offer. Not pre-approved, but pre-qualified. This is a letter that says you are likely to qualify up to a certain loan amount and gives you the confidence to make offers. Okay, step 4, calculate the DSCR on every deal before you make an offer. Use the verified SDE divided by the estimated annual loan payment. If it doesn't clear the 1.25 with room to spare, the purchase price is too high for SBA financing at that structure. And you either have to renegotiate or look at alternative financing. One more thing before I close, seller financing. In video 9, we're going to take a deep dive into seller financing specifically. But in the context of SBA, it's worth understanding that seller financing and SBA financing are not mutually exclusive. They can work together. A common structure on a business acquisition is the SBA covers 70 to 80% of the purchase price, the buyer brings 10 to 20% to the table, and the seller carries a note for the remaining on a standby basis. This structure reduces the SBA loan amount, which improves your debt service coverage ratio. And it can make a deal work that wouldn't work with just pure SBA financing. Not every seller will do this, but motivated sellers often will when it's explained properly. And in deals where SDE is tight relative to the asking price, this structure can be what makes an otherwise unfinanceable deal approvable. When pure SBA financing doesn't work, the purchase price is too high relative to SDE, or the collateral is insufficient, or the DSCR is too tight, seller financing may be a path forward. Not instead of SBA financing, but alongside it. The full conversation is in the next video. SBA loans are generally one of the best tools available for business buyers who are buying a business under $500,000. I'm not here to scare you away from them. I'm here to make sure you walk into that lender and the conversation you have, you know exactly what they're looking at so that you can position yourself accurately and make offers that your financing can actually support. Listen, the SBA due diligence checklist is in the Firewatch Business Lab on school.com. It does include a financing section. It's free to join. If you haven't downloaded it yet, the link is in the description. And if you want to talk through your specific financial picture, credit, liquidity, DSCR on a deal you're looking at, that's exactly what I do. And we can talk about it one-on-one in the free to join Firewatch Business Lab on school.com. Again, the link is in the description. We can look at your real numbers together in the lab. And if you want to learn about seller financing and how it works with SBA, you can watch this video next. And we're going to talk about when your seller becomes your lender. And please like and subscribe. You leave a comment if you have a question. And remember, it's not about finding a deal. It's about avoiding a bad one.